Hi guys, and welcome to another week ahead video. Now this upcoming week is going to be a lot more exciting than the prior one we had. We have a couple of central bank meetings coming up with the ECB, the BOJ, as well as the BOC. We also have quarter two earnings season kicking off this week, as well as a couple of very important activity data points coming out for the US in the form of retail sales, industrial production, for China the same retail sales, industrial production, as well as quarter two GDP. So it will be a far more exciting week than we had compared to the prior one. Interestingly though, in terms of risk assets, we did see a very strong close into the weekend on Friday from risk assets. So it does point to a little bit more appetite with some market participants actually not really having a problem increasing risk in the run up to the weekend. So it will be very important for us to see how the week starts and of course how the overall risk flow and risk sentiment develops throughout the week. So join me now to the week 8 video to see exactly how we're preparing for this week's events and how we can hopefully trade them in this upcoming week as well. Now, the week ahead should give markets a lot more to keep them busy. We've got a very busy lineup in terms of upcoming events. In the mix, we have 3 central bank meetings, one from the BOJ, the BOC, the ECB. We also have key US and China economic data, the start of Q2 earnings season, and the ongoing fight, of course, against COVID-19. Now, this past week saw markets continue to shrug off the rising coronavirus cases as investors have become very accustomed to the alarming increases on a daily basis, despite the fact that we've seen some early warning signs that the fatality rates are also now on the rise. Now, risk assets had a little bit of a bumpy sell-off on Thursday, with various analysts citing a plethora of reasons, but Friday's very strong rally into the close and some more positive news regarding the drug remdesivir and a optimistic outlook from Fed's Kaplan shows that markets are still leaning more positive versus negative. However, the amount of investors still sitting on the sidelines in cash right now is indicative of the type of uncertainty still present in the markets. According to Phil Orlando, chief equity strategist at Federated Hermes, this money is arguably coming out of risk assets and adds that this extraordinary amount of cash still sitting on the sidelines is one metric that you can put your finger on that would suggest you've got some concern still remaining in the market. We've also got analysts from Wells Fargo that's recently cited or warned that the market might be getting ahead of itself and explained that the risk of a melt-up is getting higher. And this echoes comments from other analysts as well, who have dubbed this recent rally in risk assets as the most unloved rally ever, as it's more driven by intervention from central banks and liquidity injections as opposed to the actual outperformance in terms of earnings and the overall economy. Now, having said that, there has been some encouraging signs recently with the recent economic data, something like NFP, which has 2 consecutive great months now in terms of better than expected numbers. Yes, there's lots of caveats with this. There's some miscalculations. The thing to keep in mind is that the market doesn't look at it that way. We need to look at it the way that the market looks at it. And right now, the market sees better than expected numbers, and that feeds into that overall recovery narrative. We've also had better than expected ISM manufacturing and ISM non-manufacturing or services numbers in the US, both beating expectations to the upside by quite a big margin. And as we said, yes, there's caveats to this data when we look under the hood. And yes, it seems that risk assets are getting ahead of themselves when looking at these data points in a little bit more detail. But we should always remember that the stock market is not the economy and the economy is not the stock market. So that doesn't mean that the risks doesn't exist. As we've seen, many economists, many analysts continuously warn the market over the past few weeks and months about the upcoming strain that's still being expected for economies around the world. But from an individual trader's point of view, it simply means that we should take our medium-term biases right now with a very big pinch of salt and try to still take advantage of the shorter-term opportunities with a very tight leash in terms of risk management. In the week ahead, we have a whole bag of events. Of all of these, we think the 3 upcoming central bank meetings, the ones from the BOC, ECB, and BOJ, probably going to have the least impact in the markets this week. The reason for that is the overall consensus across the board is not expecting any substantial or let's say meaningful changes to be announced at these meetings, rather just some further clarity on recent stimulus measures and possible further forward guidance on where the banks think the economies are headed. Now, that doesn't mean that we're just going to ignore these events. As always, we are going to prepare for it. We're going to prepare for any possible significant overly dovish or overly hawkish tilts, which can be market moving and can create trading opportunities. However, in terms of actual trading opportunities, more market focus might be tilted towards further possible recovery data points from the US, such as retail sales, industrial production, and of course China's Q2 GDP data. Apart from that, we also have Q2 earnings kicking off in the US and the upcoming meeting between the European leaders on the way forward with regards to the EU Recovery Fund that starts on Friday and runs till Sunday. Now, looking at the first one there, the recovery themed data, this week we'll see a few important data points which will either feed into the current recovery narrative and possibly give risk assets another reason to feel frisky, or it might start to pour some cold water on the recent exuberant positivity that we've seen. Starting with China, we have Q2 GDP, also have retail sales and industrial production. As the first country to come out of the very strict virus lockdown, the market has looked at China as a type of barometer for how the recovery might look in other countries. Now, apart from that, at almost 19% of total world GDP, China's economy really matters in terms of the overall recovery narrative. Now, according to ING, the recent strong rally that we've seen in Chinese stocks, as well as the strength in the Chinese yuan against the greenback, has already done quite a lot to boost overall market optimism in this recent week. And if we do see a much bigger than expected positive surprise in either of the important data points coming out of China, that could just top up the punch bowl, so to speak. We also have important data for the US in the form of retail sales and industrial production. We also have prelim University of Michigan consumer sentiment and inflation expectations, as well as another round of jobless claims on Thursday. Now, it seems there is a positive expectation going into US retail sales for June, with Scotiabank noting some upside surprises with the 7% month-over-month climb in the volume of vehicle sales and a continued climb in weekly chain store sales. Also at Wells Fargo note that there was a noticeable pickup in high-frequency mobility data that also points to a possible pickup in activity. So consensus is looking for a print of 5.3 in June versus the staggering jump that we had in 17.7% for May. Looking at Q2 earnings season, should be interesting. This week we have 35 companies of the S&P reporting earnings, which include some bank names like JP Morgan, Goldman Sachs, Wells Fargo, Citi, and other names like Netflix as well. Now, there is currently a lot of hype about earnings with a big question mark on how bad the numbers will be. Now, the biggest takeaway for me personally was that the majority of participants already expect overall S&P 500 earnings for Q2 to show a drop of 43.9%. So the real risk might not really be downside risk after all this week, as a lot of downside is already being priced in, but rather upside risk if earnings are slightly less bleak than the negative 43.9 anticipated, or if the overall forward guidance given by corporates after a slightly more optimistic tone. Looking at the third focus point, politics in the week ahead, the similar political themes will ramble on, with Brexit negotiations set to continue on Monday. We also have the EU Council meeting face-to-face on Friday, Saturday and Sunday, with the big question, of course, being what type of progress can be made with regards to the compromise proposal seen by the EU Commission in terms of the recovery fund. Now, as the EU Council meeting is taking place from Friday, and the EU Recovery Fund discussion only preliminary scheduled for Sunday, the only highlight, so to speak, from this will come from possible comments from the Frugal 4 members before the actual meeting, so keeping track of that throughout the week. Apart from that, the rising tensions, of course, between China and the West regarding the new Hong Kong legislation will also be important if we do see any meaningful or significant retaliation. In terms of the virus, so far the market resilience to rising virus cases has been growing by the week. Unfortunately, now the rising cases are starting to translate into higher fatality numbers, and if we do see fatality numbers make the same type of jump to the upside as we've seen in case numbers, that can really weigh on overall risk sentiment. Now, the reason for this is mainly due to consumer sentiment, not only from the health prospect, but if consumers start feeling afraid of going out, it will change their spending habits, which will ultimately weigh on the overall economic recovery and future growth prospects. Now, we will publish a detailed daily risk event outlook report in the terminal every day as usual to highlight the market's current consensus and minimum and maximum expectations for these very important upcoming data points. And as usual, the report will explain what type of market impact we anticipate from these events and what type of possible market reactions we can expect from them. Also, make sure to catch up on the daily video commentary for a more detailed look at the current bias based on the daily sentiment drivers. And as we have earnings season coming up, we'll also add in the current estimates as well as the upcoming earnings for every day in the reports as well. So do make sure to catch that in the terminal every day. Looking at some possible sentiment drivers, starting with the hawkish ones. In terms of economic data, markets will be keeping a very close eye on the US and Chinese data to see whether the recovery hopes are justified or whether we start to see some cracks starting to show up. Now, any much bigger than expected beat in US retail sales and Chinese Q2 GDP data can create some further risk on flows to take advantage of. As we mentioned, in terms of earnings, there might be some more upside risk compared to downside risk given the negative expectations already being priced in going into the earnings season. And the impact might be more felt on an individual stock basis compared to the overall equity indexes. So just keep that in mind. Looking at the virus focus, just like last week, a big consideration for risk assets will be whether the recent spikes in virus cases leads to actual spikes in fatalities as well. Alongside millions of others, I really do hope that that is not the case. And if we see fatality trends remain low, the markets will probably continue to discount the large rise that we've seen in case numbers. Looking at politics, the time is ticking for the EU and UK negotiators to reach a deal. And with the harsh current economic reality in play, it's never been more important for the two sides to reach a deal. Now, even though the odds of reaching a deal this week is slim, the two sides saw a similar plateau at the end of 2019 with the withdrawal agreement, but eventually a breakthrough was made at the last minute, and we should not discount the possibility of that happening again with these intensified talks. Also keep in mind, if we do see any positive noises coming out from the frugal four states with regards to the EU recovery fund proposal, that should also be a positive input for risk assets. Turning to dovish sentiment shifts, again the data, if we do see a miss across the board in the upcoming activity data for the US and China, we can expect that to weigh on the current risk mood, as we've seen a lot of multiple warnings coming out from analysts as well as economists recently saying that the recovery data is starting to point to a possible flattening, and that can really start to weigh on risk assets if we do see any of that materialize in these activity data points. As we said, in terms of earnings, as a lot of downside has been priced in for Q2 earnings, the main focus will be on the forward guidance aspect from corporates. If corporates paint a very bleak picture for 2021 and raise concerns about employment specifically, we could be in for a little bit of a bumpy session for risk assets this week. Virus focus, again, markets, or let's say risk assets, are more focused on the positives right now than the negatives. That could change in this week if the spikes in fatalities see the same type of jumps as we've seen with recent cases as well, and we need to keep a very close eye on that trend, as big jumps could spark new concerns from a consumer spending point of view, not only a health perspective. Also politics, time is running out for a Brexit deal to be reached, and any significant major setbacks in negotiations could start to weigh on the pound, especially after this recent rally we've seen in the British pound. But setbacks also, could also weigh on the overall market sentiment, not only on the pound. Also on the EU front, the EU Council hopes that the compromise they've made, which wasn't a lot to be fair, would be enough to get a deal passed. So any significant hardline stance still coming out from the frugal four states this week before the weekend's meetings could spark some concerns for risk. But even if a deal is not reached at this meeting, markets are pricing in a deal to be reached at some point, so it might be discounted quite quickly, so just keep that in mind. Looking at the possible trading plan for the week ahead, as we mentioned, we do have the 3 central bank meetings coming up, BOC, ECB, BOJ, but we're not anticipating any significant trading opportunities from them at this time, as the markets aren't really expecting any material changes to policy stance or measures. Thus, our attention will be more skewed towards the US and Chinese data that should give some further indication whether the rebound in economic data can outpace the virus fears and other economic gravity still in the mix. So a big part of the focus will be on risk assets this week, particularly equities like the S&P 500 and the high beta currencies like the Aussie, the Kiwi, the CAD, and of course the safe haven assets like the US dollar, Japanese yen, Swiss franc, and gold. Now, there is some associated risks involved with the Aussie and the Kiwi this week, with CPI data due for New Zealand and employment data due for the Aussie, and we also have the BOC as well as an OPEC meeting coming up that we need to keep in mind for the CAD. Thus, it might be a good idea to diversify some of your cross-current risks in these high betas by also considering the euro to pair against something like the US dollar if we do see any significant risk on rallies. Also for equities like the S&P 500, also keep earnings in mind, as it does open up an additional risk factor that could affect equities more than other asset classes this week. Now, as our main focus stays on overall risk sentiment, do remember not to trade risk sentiment shifts in a vacuum. Always consider the underlying macro themes and drivers for these individual assets as well. Now, in this type of market environment, it can be quite tricky to trade into any upcoming events. This is why we would wait for sentiment shift to occur and not trade into any events this week. In this type of market environment, it's also not really wise to have too ambitious targets. If you're going to be trading on an intraday basis, it might be best to stick to your shorter targets, such as your daily S1 and R1 pivot points, your ADR highs, your ADR lows, and obviously also incorporating your many other technical factors like your support and resistance areas, your psychological price levels, etc., for the highest probability entries and exits.